Good morning, everyone. A very warm welcome to the 21st Indirect Tax Colloquium organized by VILGST and Tax Connect. I would like to introduce our speaker, Mr. Vivek Jalan. Mr. Vivek Jalan is qualified CA, qualified LLM, and LLB. He is the chairperson of the National Fiscal Affairs and Taxation Committee of BCC and I. He is the regular speaker of various professional forums on the key areas of direct and indirect taxes. During the session, please put your video and microphone off. If anyone has any query, please write it in the chat box. We will answer all your queries at the end of the session. Now we request our speaker, Vivek sir, to take the session forward. Over to you, Vivek sir.
Thank you, Pratyek. Am I audible?
Yes, sir.
Yes, sir.
Is the PPT visible?
Visible, sir.
So, good morning to all the participants and thank you for joining. We have held this indirect tax colloquium after some time this time. This 21st indirect tax colloquium, we generally have one every month, but this time we are having one after 2 months. So we'll try to cover critical issues in this webinar. And joining a live webinar, the advantage is that we can discuss on the various issues. So all the participants, whatever questions you have, do keep typing in the chat box and we'll answer all the queries in the last 15 minutes or more. And we'll discuss on the various issues when answering the questions also. So we'll go right on the topic. We have various important topics lined up, but most important is the do's and don'ts on 31st of March or thereafter. So year end 23-24 do's and don'ts under GST for the taxpayers that we'll discuss in detail, because you all know that GST is a major cost to business now. So sales and marketing department, they are the stakeholders or the custodians of the top line, that is the sales, and the finance professionals and tax professionals, as well as those professionals in the consulting space, they are custodians of the bottom line also. And when you talk about bottom line or profits, then GST expense can form a major part of the bottom line. So if you are able to guard the GST expense, to save the GST expense, and most important, optimize input tax credit, you would be able to contribute a lot to the bottom line. And there are the few things which we'll discuss in this video, in this webinar. So first of all, year ending 23-24 do's and don'ts. Most important do's and don'ts for the year end, as we have discussed in the last few webinars also, you can go to our YouTube channel. We have discussed on the video also. A very important cost in GST is the cost due to credit notes. Credit notes, it is a big risk in GST. There can be three situations in credit notes. First situation, GST credit note, which you as a supplier are issuing. Second situation, GST credit note, which you as a recipient are receiving. And third situation, non-GST or financial or commercial credit notes, whatever you might call it, which you as a recipient are receiving, right? There are risks attached to all three, some which are under your control, some which are not under your control. Those which are not under your control, we'll discuss as to how to minimize those risks and to optimize the GST cost due to the credit notes. First of all, those credit notes which you as a supplier are issuing, there are three circumstances under which, as per section 34 of the CGST Act, you can issue a GST credit note. Number one is due to deficiency of goods or services. Number two is due to sales return. And number three, which is the limb where most of the credit note, you call it passback discount credit note, you call it channel discount credit note, post sale discount credit note, whatever. All of these credit notes fall under the third limb under section 34. That is where the tax and the taxable value charged is more than the tax or the taxable value which should have been charged. So under these limb, most of the credit notes are issued. It can be a turnover discount credit note. So in turnover discount, what happens? That you have a scheme wherein you tell your dealers that, okay, those people who purchase 10 lakhs rupees goods from us during March 2024, they will get a 2% post sale discount or 2% incentive, whatever name you call. I'll tell you what name you should have or what nomenclature which you should have. But you have this scheme of post sale discount, right? Or turnover discount. So the dealer purchases 10 lakh rupees of goods from you in March, via 4 invoices, and in the last invoice, when 10 lakh rupees threshold is achieved, you issue a 20,000 rupees or 2% GST credit note, right? It can be passback discount. So you have issued a credit note, or you have issued an invoice of 1 lakh plus 18,000. Thereafter, you pass back 10,000 rupees for the discount. It can be back to back or channel discount, that is OEM to the distributor, distributor to the wholesaler, wholesaler to the retailer, and thereafter the money goes to the customer. In all these, you take the shelter under the third limb. That is, the tax and taxable value charged is more than the tax or the taxable value which should have been charged. There are three conditions which required to be fulfilled and which would be required by the officers in terms of documentary evidence while allowing you the reversal of output tax liability. Number one, you should have a pre-sale agreement. That agreement can be in a stamp paper, can be on your letterhead, can be on email, whatever. Second, very important, and where there is a misconception, that these credit notes should be linked to the original invoice. I am sure many of the participants would have a question on this, that from February 2019, there is no requirement to link the credit note to the invoices. Friends, that requirement was withdrawn only for the purpose of filing your GSTR1 return on the GST portal. However, the law still requires linking of the credit notes with the original invoices. So your assessing officer will ask you for that linking. And third condition, most important, to some extent very difficult or impossible to perform, is that it is to be seen that the recipient has reversed his input tax credit. Apropos the outward tax liability reduced by you. There is no machinery to comply with this in the GST portal. Therefore, it is suggested to take care of this mandatory requirement. This is a very important year-end to do. Kindly note, you may issue a letter once in a year, once in a quarter, whatever. So if you have not issued for financial year 23-24, please issue a letter to your customers, dealers, and get a confirmation from them that the credit notes which they have received have been taken care of and input tax credit has been reversed to such extent by them. Next, the credit notes which you as a recipient are receiving, GST credit notes, where the supplier has reversed his output tax liability and it reflects in your GSTR 2B. In such case, please do a reconciliation of the credit notes which are appearing in the GSTR 2B and ensure and you have to keep a reconciliation ready for assessment that either the input tax credit has not been taken by you in your GSTR 3B, or if taken, then such input tax credit has been reversed by you, right? I will tell you the mechanism how to ensure this, seamlessly ensure this, right? It is very easy if you follow the law. In the next slide, I will explain how to do this. Third issue in credit note is the financial credit notes which you issue to your channel partners or to your dealers or customers. In such case, there is always a question from the department, and this is a major topic which we will discuss. There is a first relief from the Madras High Court. First relief. Before this, no High Court has ruled in this. Generally, the allegation of the department is that while issuing the financial or commercial credit note, the person who is issuing the financial or commercial credit note is actually providing a service to the recipient of the credit note. Friends, here, while there are various arguments, we'll discuss this when we discuss going forward in this webinar on the Madras High Court judgment in the case of Supreme Paradise, where a relief has been granted. But question is, and important, what your companies would want from you is that there should not be any litigation, because you all know that if there is an order against you, then 10% pre-deposit at the first stage, 20% additional pre-deposit at the tribunal stage. So 30% pre-deposit would be required to be paid before you can expect some relief. So how to ensure that at the first stage, that is at the order stage only, this point is dropped? Here, important number one is to have an agreement that it is a discount simpliciter. Note my words. You must have an agreement that this is a pure post sale discount simpliciter. Number two, in the case of channel discounts, very important. So many times a discount is given by the OEM to the distributor to just pass it on to the wholesaler and wholesaler to the retailer. So finally, actually this post-sale discount may be given for the retailer. However, it is goes through the channel. So here it is important that there has to be back-to-back agreements between OEM to distributor, distributor to wholesaler, wholesaler to retailer. Many times it is seen that there is only one agreement between the OEM and the distributor, wherein the OEM says to the distributor that, gentlemen, this discount is actually for the retailer. You are a mere channel to pass on this discount. Friends, this can be suicidal. It means that you are providing a service to the OEM by passing on the discount. However, it is not so. It is a mere discount simpliciter. Therefore, have back-to-back agreements. Number three, and most important in case of financial credit notes, please do not use the word incentive in your agreements or your invoices. I have told all our clients, we have changed wherever in the invoice the word incentive was written. Please do not use the word incentive. In case an incentive, it is an incentive, it is actually a service, then it is a revenue neutral transaction. Please ask your channel partners to raise service invoice. That is a clean transaction. But if it is a discount simpliciter, always use the word post sale discount. Do not use the word incentive. So these are the important things in case of credit notes. Very important. Whatever has happened in the past. But this financial year, still there is some time in March. For this financial year, please do a scrutiny of your credit notes and de-risk yourself as far as credit notes are concerned. Those of you who are in your consulting space, you must also advise your clients accordingly and de-risk the clients. Next, year-end do's and don'ts. We'll start with ITC. We will go on to outward supply and then to the documentation. I will not go on to the general things. We will focus on those things which have already created a litigation. So how to take care of the litigation? How to de-risk yourself in March 2024 so that for 23-24 at least you are de-risked during assessment. You are assessment ready based on our experience on the first 6 years. First, now in one of the cases, we have contested and also won a case at the appellate stage, wherein now what has happened, the supplier, he has issued an invoice to our as taxpayer. Now what this supplier has done, this taxpayer was in Punjab, right? The supply was in Punjab. But what the supplier has done, he was confused between Punjab and Chandigarh, which are different place of supplies. And instead of Punjab, he has made a place of supply Chandigarh. Now, when this taxpayer who received the invoice, he also did not see place of supply while matching his 1 versus 2, 2A versus 3B, and the credit was denied to him. While finally we have come out successful in this case. However, this year 23-24, ensure that this kind of thing is not there. Please ensure that while matching 2A 3B or 2B 3B, you check number 1 whether the ITC is appearing in 2B, number 2 whether the supplier has filed his 3B, and also this place of supply, right? The place of supply which is not in your state, you cannot take the ITC. So either make the supplier change the place of supply, or you have to forego the ITC. Another big risk is now e-invoice is applicable on taxpayers with a turnover, pan-India turnover, aggregate turnover, mind that, of 5 crores. 5 crores is a very small amount, friends, and it is pan-India. Even stock transfers will come in this 5 crores. Therefore, please ensure that those suppliers who are liable for e-invoicing are actually e-invoicing to you. If they do not raise an e-invoice on you, then you will lose on to the input tax credit as a recipient of the invoice. Now, third, and as finance and tax professionals, either in industry or consulting, as I said, it is important that you de-risk, but it is also important that you optimize your bottom line. So even if generally what I told you is to see whether your 2B, the ITs is appearing, and ensure that the supplier files in 3B also. But Rule 37 capital A, which has been notified in December 22, allows you, if the ITC is appearing in your 2B, even if the supplier has not filed his 3B, you, if the amount is large, you can take the input tax credit, right? Because you have to ensure your bottom line is also protected. So even if the supplier has by mistake in the month of March not filed his 3B, right? Even then you are eligible to take the input tax credit even if it is appearing in your 2B, supplier has not filed his 3B. But after you take the input tax credit in the return of March, thereafter by September 2024, you have to ensure that the supplier files his 3B, or even if the supplier does not file his 3B even till September, you can enjoy the ITC, and in September you can reverse the ITC without interest. So there is no additional cost to you if you are taking the ITC also. And important again is, once you have claimed and then reversed in September, thereafter there is no time barring period to take the ITC. Please note, this is a very important point. If you claim and then reverse the ITC, then to reclaim the ITC, there is no time barring period. Even if after 1 year the supplier files his 3B, department cannot ask, allege, or open a case that the ITC is time barred. You can take it or reclaim it after 1 year also. So this is one way where you can actually optimize your bottom line. How do you do all this? How do you control all this? Friends, we have had various webinars on my YouTube channel. If you go in Tax Connect's YouTube channel, you can find a video where we have threadbare discussed Circular 170 of 2022, wherein the circular mandates that you take all the ITC, whatever is available in your 2B, including credit notes. You take all the ITC, net it off with the credit notes, and thereafter do a temporary reversal if it is not available in this month or the corresponding credit note is not liable to be reversed this month. Thereafter, you have to reclaim it under 4A5, table 4A, show it in 4D1, right? In the month where it is eligible to be claimed, right? If it is permanently not eligible, then show it as a reversal in 4B1. But first you have to claim it in 4A. So you have got a bill from a supplier, right, of 100 rupees plus 18 rupees GST. Same month, you have got a credit note of 10 rupees plus say 2 rupees GST. How to do this and how to comply with this in 3B? Take the credit of 18 rupees in table 4A5, net it off with 2 rupees of credit note GST amount. So take 16 rupees credit in 4A5. Thereafter, reverse it temporarily. Say you will receive the goods or services in the next month. Reverse this 16 rupees in 4B2. And in the month of April, when you have received the goods or services, say for example, okay, Rajiv is saying that voice is not clear. Avik, is my voice clear? Hello?
Yes, sir, clear.
Clear. Okay. So Rajiv, you have to see your connection. So in continuing with the example, when you reclaim it in April, you have to show it in 4A5 again, as well as 4D1. Friends, many a times, some taxpayers counter that this is a circular. It is binding on the department, not onto us. Why should we follow this circular? Please note that the circular is also notified. Why? Notification 14 of 2022. Therefore, if the circular is not followed, then it may expose the taxpayer to a penalty of 25,000 rupees per GSTR 3B filed for non-compliance with notification 14 of 22. Further, if you follow this mechanism, then you will see that your input tax credit is completely streamlined and you are able to save a lot of cost, optimize the ITC, and not leave out even 1 rupee of ITC because of the way the compliance will flow. So this March, even if you have not followed this circular over the last year, 23-24 also, you may ensure that in March for the full year, you follow this circular, right? You can do an impact, you can do a retrospective adjustment in the return for the month of March. Again, another important reconciliation to be done at the year end. You may see that many government customers or e-commerce operators, they are collecting TCS or deducting GST TDS. If you do not reconcile your GSTR 2B, this TDS TCS amount which is showing in your GSTR 2B, then in your books of account, this amount will show as debtors while it is actually cash. So your liquidity ratio or working capital ratio in your balance sheets will be impacted. Therefore, do a reconciliation of TDS, TCS also and ensure that your books of accounts TDS TCS balance match with your GSTR 2B. You might say that is there a loss? Yes, there is no loss, but in your balance sheet, it will flow from debtors to cash. Therefore, from working capital, it will go to a liquid asset, right? Current asset, it will go to liquid asset. So your balance sheets will improve. Next, when following this circular 170 or notification 14, as I was discussing, you must ensure one table. The most important table becomes 4D1, where you reclaim the ITC, and 4B2, which is temporary reversal. Ensure that all your temporary reversals ITC in 4B2 is reclaimed back. Also ensure that accumulated reclamation in 4D1 is less than or equal to temporary reversals accumulated in 4B2, right? This is very important because now you have an electronic credit reversal and reclaim statement automatically on coming on your GST portal. Therefore, if your 4D1 reclamation of ITC is more than your temporarily reversed ITC in 4DB2, then you will get a DRC 1B, right? So this 4D1 and 4B2 becomes very, very important. Of course, 2A3B reconciliation or 2B3B reconciliation is important. Import ITC. All of us have faced this situation where bill of entries ITC is not reflecting in our 2B. If it is not reflecting in your 2B, there is an option. Please fetch the bill of entry. There is an option and there is a functionality of fetching bill of entries. Even if after fetching bill of entries, some bill of entries are not reflecting, please go to IceGate and ensure that those bill of entries are in the IceGate. If they are not in the ICE gate, not in 2B, ensure that for all those bill of entries, you cannot lose ITC, right? You cannot shake up your balance sheet just because of a glitch in the GST or ICE gate portal, especially in case of land customs like Nepal, Bhutan, etc. This kind of errors happen. So even if it is not appearing in your 2B or not appearing in IceGate, the ITC for imports will be eligible on the basis of bill of entries, but ensure that you raise a grievance to the help desk and keep a copy of the grievance in your file for assessment so that during assessment, such issue does not come up. Next is proportionate reversal, right? Just a second. Yeah. So next is proportionate reversal of ITC under Rule 42 or Rule 43. Important is to see your exempt supplies or non-GST supplies. Most of us will say we do not have exempt supplies, but there might be minor exempt supplies, right? Like municipal waste, which you are selling, it is an exempt supply. Most important, which most of the taxpayers miss out. Please note, the 1% of the sale value of the investment. So, even if you are purchasing and selling liquid mutual fund on a daily basis, many of the taxpayers, they park their money on a daily basis in liquid mutual fund, right? And whenever they require money, they redeem the mutual fund. 1% of the sale value would be considered to be exempt supply, and you have to reverse the proportionate ITC. Most of us are missing on to this. So this may be the right time to at least comply with it in this financial year. Ensure that you apply for your LUT for the next year. You all would be having stock taking exercise at the end of the year. While accounts sometimes, unilaterally writes off certain stock as lost, stolen, destroyed, but sometimes we all forget to reverse the proportionate ITC. Please ensure for all these year-end stock taking, goods lost, stolen, destroyed, the proportionate ITC is also reversed. But a very important point, do not reverse ITC in case of slow moving, non-moving items, because they are not goods destroyed. They are merely goods which may not be saleable. Further, some goods may be damaged, but in case of damaged goods, no ITC reversal is required. I am repeating, there is a difference between goods destroyed and goods damaged. If you are selling, say, a refrigerator, the very fact that you have a scratch on the front door of the refrigerator, it means that maybe the value in your books of accounts you are reducing, right? But the refrigerator will be sold as a refrigerator. But in case the condenser is itself destroyed and the refrigerator is written off, a value is provided in the books of accounts, and it will be sold as a mere iron and steel. In that case, ITC reversal is required because it is goods destroyed. Now, pay all outstanding within 180 days from the date of the invoice. We will discuss this. This is a very important, in fact, one of our, very, very renowned taxpayers, we were discussing with him this 180 days. What do you do in case your contract itself says that you have to pay after 1 year? In one of our cases, one of a very big taxpayer, their contract was, it was a back to back contract. He was purchasing from somebody and selling to somebody. So he was required to pay to the seller when his customer would have paid him back. And the customer did not pay him back for the last 9 months. Therefore, the department asked for interest and ITC reversal. Does this ITC in these kind of cases required to be reversed? Our view is no. There is no requirement of reversal of ITC even if the payment is not made within 180 days, because there is no failure of payment. It is a terms of the agreement, right? So very important when you are doing this 180 days calculation, important is to see the terms. We will discuss this. I have a few important points to discuss on this, which we'll discuss going forward. Now, the invoices which you receive from your suppliers, ensure those invoices are compliant. So many of the suppliers you will see they are still using, especially in case of services, they are using 4-digit HSN code. That is a violation of Rule 46. The invoice of the supplier becomes faulty, right? And the department might challenge your input tax credit. So ensure that your suppliers' invoices are also as per Rule 46. Ensure common credit is distributed through ISD. Now, from this Budget and Finance Act 2024, ISD will become mandatory from the date Section 2, subsection 61 and Section 20 of the IGST Act is notified. So important is to take your ISD registrations and start distributing the common credits. I will come to that and we'll discuss this more in detail. So this was regarding the year-end do's and don'ts for ITC. For outward supply, 6-way reconciliation is important. GSTR 1 versus e-invoice, versus 3B versus e-way bill versus books of accounts and income tax turnover, right? Six-way reconciliation, very important. Most important among that is ensure that you have issued all your e-invoices. Many of the times we have seen e-invoices are forgotten to be issued. Many of the times e-invoice issued, but simultaneously also cancelled due to some system glitch. In those cases, there might be an exposure for penalty. So in those cases, it is important. All you do a year, full year 23-24 scrutiny, see in case an IRN is not issued, please issue the IRN now. How you will issue? You might ask me a question that, sir, we have raised the invoice in December 2023. Now in March, I found IRN is not issued. How can I issue the IRN? Right? Our suggestion is, again, this might not be a completely suggestion as per law because the law does not prescribe anything for such kind of non-compliances. But you may look to issue the e-invoice today after canceling that invoice through a credit note, right? Or you can inform the department. So in the earlier era, central excise or VAT, what we used to do in case of any non-compliance which we have detected, we used to inform the department so that there was no allegation of suppression at the time of assessment. But mind that you might inform to the department, but if you don't issue the IRN, then your customer will lose the ITC, right? Very important. So your customer will not pay you the GST amount if you don't issue the IRN. So in our view, this is the best approach in the circumstances to issue a credit note of the earlier invoice, issue a new invoice. At the maximum, there would be an exposure of interest on time of supply, right? But at least your customer will pay you the GST amount as he will not lose the ITC. Many of the times, taxpayers are not filing the shipping bill numbers in their GSTR1. Please ensure you amend and file the GST shipping bill numbers also. Payment on reverse charge basis, RCM liability, many of us miss out. Most important is see in case any supplier has shown tax payable under RCM, it is appearing in your 2B as RCM payable. You have either paid, in case not payable, you have taken sufficient action because there is an exposure to that. File your ITC 04, add all places of business in your additional place of business. Many a time stock are lying somewhere, right? And those places are not added as additional place of business in our GST portal. In case there is a department investigation, please note there would be a huge penalty in this case. There are practical problems like in FMCG companies. If any of you are dealing with FMCG companies, sometimes you provide the refrigerator to your dealers. The refrigerator is actually at your dealer's place. In case of construction company, many of the time, some of your equipments are at the site. So what to do? As of now, the GST law mandates addition of these places as your place of business, right? Therefore, you have to take a call, and there is a limitation on the GST portal also, not more than 500 additional place of business can be added. Therefore, maybe a manual application on your GST portal to your JAO is important, so at least you are compliant with Rule 56. Check your own place of supplies. Okay, yeah, please keep on typing your questions. I will answer all of this at the end of the webinar. Delivery challan, self-invoice, receipt voucher, payment voucher. Many of the taxpayers, I would say most of the taxpayers, are not issuing self-invoice on RCM, payment voucher, receipt voucher for advances received in case of services, delivery challans, and many of the suppliers are skipping reporting this in table number 13 of GSTR 1. In case it be so, please do a reconciliation. March 24 is the best time where for the full year 23-24, at least the count, if you have skipped earlier, you can disclose it and regularize for the full year. Documentation and books of accounts, as I have said, that self-invoice, delivery challan, receipt voucher, payment voucher. Many of the taxpayers have not issued. Please issue it at the end of the year so that you are compliant for the full year. Many of the taxpayers, even our clients, ask us, where is the mandate that from 1st April I have to have new invoice series? Friends, my answer is there is a GST network advisory of 2019 which mandates you to have a new series every financial year state wise. Make no mistake, the invoice number has to be state wise. Most of the taxpayers are non-compliant for credit note and debit note. I can tell you, you can check it out. Many of the softwares, they are also non-compliant as far as credit note and debit note are concerned because they have a pan-India series of credit note and debit note not compliant with GST. Ensure you have from 1st April, this is the right time to have a state-wise series even of credit notes and debit notes. Many of the taxpayers Rule 46 is not compliant as far as invoices disclosures are concerned. For GTAs, for example, GTA transporters, they are not required to issue a e-invoice, but in a normal invoice, they have to make a declaration which is there on your screen, point C3 on your screen. All transporters, banking company, insurance companies who are not required to issue e-invoices also, but in their normal invoice, they have to give this declaration that they are not required to issue e-invoices. Otherwise, they are non-compliant. Very, very important. Those of you who are selling to SEZ, please ensure a declaration is there. If you can see on your screen, point F. But, but, very important. From this year, ensure you get a endorsement at the back of your invoice or you get a declaration from the SEZ to whom you are supplying that they have received the goods or services only for authorized operations. Right? So friends, these are the very critical things which during the year many of the taxpayers miss out. But this is the right time in March 24 and April 24 where for 24-25 you can comply with all of these. Okay, ISD versus cross charge. So uh, if you can log on to our Tax Connect's YouTube video in our last colloquium on 2nd of February, just post the budget, we have discussed this ISD versus cross charge apropos the budget amendment in detail. Just a recap of that is that in the 50th and 52nd GST Council meeting taken together, it was decided that from the day when 2 subsection 61 and section 20 of CGST Act are notified as amended, from that day you cannot do cross charge for services which you have received in one GSTIN on account of other GSTINs. So till the day when this 261 and section 20 are notified, you have an option to cross charge or use ISD for distribution of common ITC. So for example, your statutory auditor raises bill on Maharashtra in your HO, where the statutory auditor also gives a service to Delhi and Chennai. Say you are registered in 3 states. As of now, you have got the option to either route it through ISD or to cross charge it from Maharashtra to Delhi and Chennai also. But from the date when 261 and section 20 are notified, you have no option, but it will be mandatory to route it through ISD. Important to note is that all past disputes, many of the states, for example, Maharashtra, Chennai, they were all raising disputes in case of cross charge for distribution of common ITC. They were saying cross charge is not valid. So after this circular 199, all these disputes will be set to rest. Third, if you see section 2 subsection 61 as amended, it seems that you can through ISD also pay RCM. But if you see section 20 as amended on your screen, it seems that you can only distribute through ISD. You cannot pay RCM through ISD, which is the norm today. We have to wait for the final amendment. But as of now, and it is our view going forward, say for example, you are a foreign company. You have to pay RCM on import of services for royalty. What do you do? Royalty is paid for all the 3 states in my example, Delhi, Maharashtra, and Chennai. If you are registered in these 3 states, say for example. So Rule 54, Sub Rule 1, capital A, requires that you paid from your HO in Maharashtra in my example, and from Maharashtra normal GSTIN you raise through ISD and thereafter distribute. Same mechanism you can follow afterwards. But very important friends, since it is already enacted, anytime the notification will come and it will be implemented. So all of you who are multi-state registered, who have not taken ISD registration, it will be mandatory. So take the registration at least in March, so that from April, you start filing ISD returns. And you ask all your vendors who are giving you common services to raise the bill on ISD registration rather than your normal registration. Thereafter, you have to reconcile GSTR 6A and pass a ISD invoice and distribute the ITC. It is a big process to implement this ISD mechanism. Therefore, it is suggested that you start it now. This is the right time. But now, a word of caution. For internally generated services, there is no requirement of cross charging. So this Columbia Asia advanced ruling that has been negated by this circular 199. However, many of the taxpayers, I understand, they are doing a cross charge merely to transfer the input tax credit from one state to another. Friends, this is an offense in GST. You cannot merely raise a service invoice on your branch in another state to transfer the ITC. In case such a mechanism is being thought of and under the pressure of the day-to-day business, it is important that we do not take such calls. Now, again, important thing which comes out of this section 20 as amended is that a question can be asked whether one ISD can be taken for a one company, one PAN number, or you can take multiple ISD. Friends, again, this can be a ITC optimization tool. Say, for example, you are doing a dealer conference in Bangalore. Your HO is in Maharashtra, right? You are registered in Bangalore also. And you are doing a pan India dealer conference in Bangalore, right? You can do that. Then the hotel will charge you C plus S in Bangalore. You cannot take the entire ITC in Bangalore. How do you distribute? Because I am saying do not cross charge. It is our suggestion that to streamline this process, you can take multiple ISD registration. There is no bar. I am repeating, there is no bar for multiple ISD registrations. You can take another ISD registration in Bangalore and distribute the ITC. So that will be a regular process. One few very critical issues in ISD. A question is asked whether guest house ITC, guest house, you are paying a rent, you are making repairs in your guest house, you are hiring security personnel in your guest house. Can the ITC be taken? Well, some of you might quote this appellate advance ruling in the case of NALCO. However, our view is that ITC for guest house, rentals, repair and maintenance, security can be taken because the guest house is an integral part of the business. Just like you have to offer a sitting space to your employees and your consultants. When these same employees travel to outside the base location, you have to give them a residential accommodation. If you do not have a guest house, you have to take a hotel room. And there is no bar for taking ITC on hotel rental. So guest house ITC can be taken because it is for furtherance of the business. This expenditure has been incurred to actually reduce your cost. And ITC can be taken, but when ITC cannot be taken is in case this guest house expenditure you charge to your employee as perquisite, then the ITC will be barred. Or you collect some money from your employees or consultants, etc., for these guest house charges. To that extent, ITC will be barred. But otherwise, ITC for guest house rental, guest house repair and maintenance, guest house security, in our view, it is eligible. With this, you might ask another question. Sir, you have said guest house repair and maintenance, ITC on civil work, that is barred under section 17(5)(c) and D. How can you say that? That is my next point for ITC optimization. Friends, under section 17(5)(c) and 17(5)(d), in case of plant and machinery, there is no bar for ITC, whether you capitalize or not. Even in case of other civil work, for construction of for construction of your own premises, and construction includes reconstruction, repair, renovation, alteration, addition, there is no bar to take input tax credit if such expenditure has not been capitalized in your books of accounts. So you have to prove that as per accounting standard 10 on property, plant and machinery, you have to charge this expenditure off and not capitalize it. In case you can prove that, in case you are charging off this expenditure, in our view, there is no restriction for taking the input tax credit. A question was asked very recently by the Karnataka state authorities. So one of the taxpayers, he was under the process of, you see, making a factory. Now, in a factory nowadays, there are portable toilets and even portable offices. You can pick up the portable room and relocate it. In the case of Sirpur paper mills, the Honorable Supreme Court has held that any goods which is capable of being dismantled and relocated without being destroyed, that is a movable goods and not immovable property. In our view, ITC on these kind of portable toilets, portable rooms, portable offices are eligible because they are movable items, not immovable items, not blocked under 17(5)(d). However, how to ensure that you do not fall under litigation? Because the same contractor would be issuing you a works contract services invoice or construction services invoice. Please segregate your purchase orders and your invoices for movable items and works contract or construction services, so that movable is distinct from immovable, right? So very, very important. Now, again, another issue is litigated by the department. What about lease rent? ITC on lease rent taken for 99 years lease. Well, our view is that you cannot play hot and cold at the same time. And since it is a lease simpliciter, ITC is eligible. It is, you cannot classify a 99 years lease as a land, because there are multiple cases. And now the case is even in Supreme Court that on the lease rental, the department is contending it is not sale of land, therefore GST is liable. Therefore, you cannot play hot and cold. On the one hand, you cannot say on the case of outward supply, it is not sale of land, so GST is applicable. And while taking ITC, you cannot say that no, no, this is a immovable property, so GST is not applicable, ITC is not available. So lease rental, long-term lease rental, ITC eligible. What happens in case you pay RCM by mistake? RCM was not applicable. You pay RCM. Can you take the input tax credit? If eligible, our view is yes, it is eligible, right? You can go through this PPT, it will be shared with you. What in case you don't have an inward e-way bill? Supplier has forgotten to make an e-way bill and you receive the goods. Can the ITC be denied to you just merely because you do not have an inward e-way bill? Our view is no. It is not a requirement under section 16 subsection 2AB that you require an e-way bill to claim ITC. If you can demonstrate by a GRN, etc., that the goods have been received, merely because there is no inward e-way bill, ITC cannot be denied. And as I was discussing few minutes back, what in case the terms of your agreement, just like in case of retention payments, the term of your agreement is that the payment is outstanding after 2 years. Would a reversal in 180 days be required under second proviso to Rule 16 subsection 2? In our view, second proviso to Rule 16 subsection second proviso to section 16 subsection 2 read with Rule 37 is applicable only in case a recipient fails to pay fails to pay is not defined under the GST Act, but it means neglects to pay. So if you read this sentence, second proviso to section 16 subsection 2 provided further, where a recipient neglects to pay the supplier of goods or services or both, the amount towards the value of the supply along with the tax payable thereon within a period of 180 days from the date of the invoice by the supplier. An amount equal to input tax credit availed by the recipient shall be paid by him along with interest under section 50. So, is there a neglect to pay? In such case, answer is no. Therefore, in our view, such reversal is not required. Taking the argument forward, if such was the intention of the statute, that even in case of retention money, even in case where the terms of the contract required so, ITC would be required to be reversed. Then why would ITC be required to be taken? Why will I, knowingly that I will not pay to the supplier within 180 days, take the ITC and be liable to pay interest? And after 2 years, if I am going to pay the supplier, then will the department not allege limitation under section 16 subsection 4? And second provision to 16 subsection 2 is found to be odious when read with 16 subsection 4 to the extent of six retention payments and terms of the contract, and it cannot be the intention of the law. Therefore, our view is that in case there is no failure of payment, reversal of ITC is not required even in case they have been paid after 180 days. Northern operating system. Now, again, you see, first, the department has raised a liability in case of expat salary paid after the Supreme Court judgment in service tax in case of Northern operating system. So they are saying that you have to pay RCM in case of expat salary. Now, when you pay the RCM, they are saying that you are not eligible to take the ITC today. In our view, this contention is not correct. The time for taking the RCM as per section 16 subsection 2 A is when you have a valid document. What is a valid document under section 16 subsection 31 subsection 3 clause F of the CGST Act? The valid document to take the ITC is a self invoice. So the moment I make a self invoice, only then I can take the ITC, and my time barring period starts from the date of the self invoice. Yes, I may be liable for interest on time of supply basis. So in a similar case, in case of Toyota Kirloskar Motor Private Limited, the Honorable Karnataka High Court has stayed the proceeding for dispute of ITC. Another very favorable judgment. So there is always many times there is a contention of the department in case you do not take the ITC in the time barring period by 30th of November, but you take it in December and file the GSTR 9 with ITC, then the contention is that such ITC is not eligible because the time barring period under 16.4 is violated. The Honorable Madras High Court in the case of Shanmuga Hardwares has ruled that such ITC if it is appearing in your 2B, even if it has not been taken in 3B by the time barring period, but if it has been disclosed in GSTR 9, such ITC is eligible if other clauses of section 16 subsection 2 are fulfilled. Therefore, this is a very favorable judgment and it will come to the rescue in all time barring cases. Already, the Honorable Apex Court in the case of Bharti Airtel has answered a cardinal question that 2A, 2B, all of these are procedures, but ITC can be claimed in the books of accounts. And books of account is the basis for claiming the ITC. Another relief, as I was discussing initially in the webinar, is in the matter of commercial credit notes. So I have discussed in the do's and don'ts section in case of commercial credit notes for passback, for turnover discount, for post-sale discount. Do not use the word incentive. Try to link the credit note with the invoices, have an agreement, and at each level of the channels, you should have the agreements. The contention of the department in many cases is that it is a service. In such similar case, in the case of Supreme Paradise, the Honorable Madras High Court has ruled that such a commercial credit note or financial credit note, whatever it might be called, cannot be regarded as a consideration for a service rendered by the recipient of the credit note, and it is merely a discount simpliciter. So if you have such a case, you can take the benefit of this High Court ruling. So again, in another favorable verdict in the case of Aicha Motors, the Honorable Madras High Court has ruled that even in case you have a cash balance in your electronic cash ledger and you file the 3B late, there would not be any interest applicability. So on your screen, we have the example. Say your GST payable for Jan 24 was 10 lakh, electronic credit ledger balance 8 lakh, cash ledger balance 2 lakh. You have filed the GSTR 3B on 25th of February, that is 5 days delay. Is any interest applicable? Answer is no. If you have sufficient credit ledger and cash ledger balance both to deal with the outward tax liability, there is no applicability of interest. Okay, few other important issues while we are, saying, with discussing the various defenses. Those of you who may have been dealing with the authorities in Chennai, you might be aware that many of the times the authorities, especially, you know, in Tamil Nadu, I have seen, you know, there is, sometimes a misconception and the entire trial balance for the full company for all the states taken together, the company trial balance or balance sheet is taken and GST liability is calculated on the pan India basis. Sometimes hearings are not provided. Sometimes adjournments are not provided. There are up to number of Madras High Court judgments in such cases remanding back. But important is also to revert to the show cause notices. So on your screen, in the case of Ralco Synergy Private Limited, while in such a case, the Honorable Madras High Court has remanded back the matter to the assessing officer, yet because the taxpayer also did not respond to the show cause notices within 2 months, they have mandated a 5% payment of pre-deposit. So please do not neglect any notice. Corporate guarantee has been stayed. The GST on corporate guarantee was invoked in October 2023 by circular and thereafter amending Rule 28 of the CGST rules. The question was whether the GST on corporate guarantee was retrospective or prospective. The department has contended it is retrospective, but that has been challenged by the taxpayers in the case of Sterlite Power Transmission in the Delhi High Court. And if you see the circular states that no GST is applicable on personal guarantee of the directors because as per RBI norms, no consideration can be charged. If you see the past corporate guarantee letters of the banks, you will see even in case of corporate guarantees, such a condition is there. Therefore, the same ratio of personal guarantee applies to corporate guarantees, and in our view also, it cannot be retrospective. Next question is whether it is prospective. Answer is yes, of course. The moment Rule 28 was amended, it became applicable. But the deeming fiction of 1%, that is an onerous burden, and the valuation primarily has been challenged in the Honorable Delhi High Court. So, till such time when the decision comes and a decision is reached, till such time, possibly there is a breather in case of corporate guarantees, because generally in case of foreign subsidiaries, this becomes a cost and 1% is a value which is impossible. Also, in case of exempt supply companies like alcohol companies, diesel, petrol, manufacturing companies, where GST is not applicable on their outward supply, so no ITC is available. In such cases, this 1% charge, this is an onerous burden, and this entire transaction of corporate guarantee becomes a problem. Okay, last is you apply for a refund, don't get a refund within 60 days. Interest need not be claimed by you. It is automatic if the refund is not received within 60 days. Many a times the department requires you to sign a waiver form. Even if the waiver form is signed by you, 6% per annum interest after 60 days from the date of the application is automatically eligible to you as a taxpayer. Interesting judgment which can be taken benefit of by all the taxpayers. So, friends, this is it from my side on the issues today. I'll take some questions, all the questions now. Back. Okay, Mr. Yadav states state GST is carrying out investigation under section 67, collecting and verified record for the last 4 years for last on month. Okay. In between received intimation from jurisdictional central CGST for conducting audit under 65 for the same years. Now section 6 of the act is useful against audit like verification of the same records for the same period by two different GST authorities. Yes, you are right, Mr. Yadav. If the authorities are doing a section 67 for all the years and not for a particular issue, then you can contest it that for the same period, either the investigation authority limit the investigation under section 67 for a particular issue, or audit under section 65 for the same period is not possible. There was recently a relaxation from the one judgment of the High Court is also there in this regard. Okay, how to disclose GST in the GST return if there is no sale invoice but there is a credit note for the past period? Yeah, very important, and practical problem. Mr. Singaria, this was a problem in the erstwhile central excise or VAT law also. In this case, you cannot disclose till the time period you have an outward supply liability. This is the practical issue. But your next question will be, what happens if 30th November is reached and time barring period is there? In such case, you see, you have to take it on practically, and possibly you may disclose it as an ITC and with a letter to the GST authorities. While that might be litigated, but thereafter you can contend that it was an impossible performance. There was no way to disclose this. However, it is our view that you must do some transaction and thereafter knock it off against the credit note to avoid litigation in case possible. Is export an exempted supply and whether proportionate reversal of ITC is required? No, it is clear export is not exempt supply. Refund of ITC is available. Does proportionate reversal of ITC only in case of ITC on corporate expenses or entire ITC? So as I have said, you can claim a refund. There is no requirement of reversal of ITC. What is the liability if the e-invoice is issued but the goods have been supplied without e-way bill? As I have already discussed, e-way bill is not a mandatory document for claiming ITC, so ITC is eligible. ISD registration and distribution of credit is mandatory from 1st April 2024. No, as of now it is not mandatory, but it is enacted. As you know, in GST, the sections and the amendments are valid only after it is notified and approved by more than 50% of the state legislature. So you have to wait for the notification till ISD becomes mandatory. However, it is already enacted, so it is merely a matter of time. And that is why my suggestion is to implement it immediately, because it will be implemented from the day of the notification. So then you will not get a time. Mr. Amit Deshpande says we have billed a customer 100 plus GST while rejection customer debited us 105 plus GST. As per SAP, we have post return transaction. We cannot post 105. Okay. Yeah. Important. Good scenario. Number one. As per the GST law. Okay. Under section 34, there is no way by which a recipient can issue an invoice for a sales return. It is only one-way traffic, so you can only issue a credit note of 100 plus 5. I assume, okay, 100 rupees plus GST. Now, in case your customer has debited you 105 plus GST, now this profit of 5 rupees, that is your internal issue. However, the customer has raised, in case he has raised a debit note that is irregular under section 34. If he has raised a tax invoice, in that case, he is treating as a sale and not as a rejection. In such case, a practical view may be to take the input tax credit of the GST on the sale invoice if issued by the customer, right? However, this 5 rupees, whatever he has done, that is your agreement. You can always, you have the option to dispute, but in case you go strictly by the law, you can always dispute this entire invoice under section 34. Customer cannot issue you an sale invoice for a sales rejection. It is the mandate as per GST law that it is only you who can issue a GST credit note in such a transaction. Mr. Bhattacharya says transit shortage recovered from the transporter but debit note and customer is credited by credit note. Is GST applicable on both debit note and credit note? Okay, very important issue which all industries, all taxpayers might be facing. So you have a transit shortage and say one product is missing. So you, first of all, you have to raise a GST credit note on your customer, right? Because customer cannot take the credit of that one short supply. So GST credit note issued. Next, this 118 rupees you receive, you charge from your transporter. This 118 rupees is a charge in the nature of liquidated damages, and there is no liability of GST on liquidated damages. Therefore, there is no applicability of GST in such case. When you raise a debit note or an invoice for liquidated damages on the customer. Mr. Ragi says we have multiple GST registration, but we are selling exempted goods. Is need to take mandatory ISD registration? If yes, can we file nil return? See, if you go strictly as per terms of 261 and section 20, whenever they would be notified, it is mandatory to take GST registration, ISD registration, and distribute the ITC, and thereafter reverse that ITC after claiming it under notification 1422 in such state where it is distributed. So if you are, say you are an alcohol company, you have to still take a GST ISD registration, distribute the statutory auditor's credit to your branch. Your branch has to claim the ITC and thereafter show it as a permanent reversal under 4B1. You can ask me a question that, sir, this is a complete revenue neutral exercise. Is this not a waste of time? Yes, it might be. But in case you do not take the registration, then it is a non-compliance with section 2 subsection 61 and section 20 of the CGST Act. You might be liable for penal action under section 125 of the CGST Act. Okay, next question. Kokila says, is interest required to be paid under Rule 37 if ITC has been already reversed on reaching 180 days? No, no requirement of interest if ITC reversal has happened within 180 days. Okay, next is taxpayers registration was cancelled due to non-filing of the returns. Subsequently, after restoration, taxpayer registration, the department issued SCN to deny credit on the limitation ground under 16.4. Your views including any judgment. There are obtained number of judgments, even Rule 37A, even for reclamation of ITC, there is no time barring period. So if you have claimed and reversed the ITC, now you are reclaiming, there is no time barring period in such case. Rule 37A makes it clear, section 16.2 makes it clear. Mr. Ashok Jha says, as per Aicha Motor judgment, if the partial outstanding GST liability is paid in cash and returns filed after some time by payment of full tax liability by cash, will we get interest relief to such extent as cash initially paid? Absolutely. To the extent cash ledger balance is there, to that extent there is a relief from interest. To the extent liability is unpaid, by credit or cash ledger, only to such proportionate extent interest is applicable. Mr. Amarnath says, is trial balance mandatory for a state having third party warehouse of a company? If I understand it correctly, you have a warehouse in a particular state, but if you have a warehouse, you must have a supply from that state. Therefore, if I understand this question correctly, yes, trial balance would be mandatory. Again, now some people might dispute this because I know it is a problem in all with all the taxpayers. You might ask me a question that, sir, under which section is trial balance mandatory? My view is that under section 71, while it might be for access to place of business, trial balance is mandatory requirement to disclose to the officers under section 71. Therefore, it must be mandatory state-wise, applying the ratio of section 71, right? Mr. Modi says, can the department issue ASMT 10 for the financial year for which audit under 65 has been concluded? Mr. Modi, there are two distinct sections, 61 and 65. So yes, ASMT 10 can be issued for that period where 65 has been done. However, not for the same issue which was dropped or discussed under section 65. If you can prove the same issue has been taken up under section 65, to that extent the proceedings are OTOs. Mr. Mishra says, is there any time limit for department to issue DRC 12 for SCN drop case? In one of the case, it is pending since 2019. DRC 12, I have to check this. If you can tell me what is this DRC 12? Somehow DRC 12, just skipping my mind. Mr. Hemant Patki says, can e-invoice be cancelled or amended? Yes, e-invoice can be cancelled, not amended, but cancelled within 24 hours. What is the time barring limit for audit under 65? Can the department issue audit for 1718? You can go to my YouTube channel, Tax Connect's YouTube channel, and I have discussed this in detail as per the recent Madras High Court judgment. Yes, the department can issue you a section 65 notice for 1718 even today, because it is the option of the department to issue a show cause under section 74. For such period, the time barring period is after 2 years. For how many years can the department issue a GST notice under section 64? As I have said, till the period is not barred under section 74, 5 years from annual return. Credit notes without GST is allowed for sale out incentive offered by suppliers. Again, you are using the word incentive uh, and you are using the word credit note. If it is an incentive and if it is a service, credit notes not allowed. If it is a post-sale discount in the nature of sale out discount, then commercial credit note allowed. Mr. Rajesh is saying 1819 GST return filled after December 19, ITC claim disallowed by the officer through DRC 7 order, then we have to go into appeal, but as per High Court order, same should be disallowed. GST return filed after December 19. So if you have claimed the ITC by September 19 time barring period, it should be allowed. Even if the supplier has filed his return after such period. Okay, Mr. Mishra says, is GST applicable on corporate guarantee to subsidiary company? Mr. Mishra, yes, after amendment of Rule 28. If yes, is it one time or on every renewal, every renewal? Because that is the type of supply. Sir, the TP could not claim taxpayer could not claim ITC due to cancellation of registration. Whether he could still claim ITC after limitation under 16.4. It's a very good question. Yes, absolutely. Because once the registration is cancelled till such and during such time, the ITC cannot be claimed. And thereafter, it can be time barring period. During such time, ITC is cancelled, the registration is cancelled. That time period cannot be counted for the purpose of 16.4. DRC 12, okay, sales certificate. This form is issued by the proper officer to the successful bidder after receiving the payment of the successful bidder in the manner as specified in the rules. I think this DRC 12 is for recovery when such assets have been seized for the bidder. So you might go into the rule and look at this DRC 12, a time barring period. Mr. Mishra says, okay, this is ASMT 12. Time barring period for ASMT 12. Yes. So the time barring period would be under section 74, right? Once it is time barred, then ASMT 12 cannot be, before that ASMT 12 has to be issued. Is it necessary to obtain GST registration during the, okay, yeah, one more addition to this point, but you must keep on following for ASMT 12, right? If it is not issued. Is it necessary to obtain GST registration during the construction of residential come commercial complex only for let out purpose? Yes, of course. If you do not take the GST registration, how will you take the input tax credit in such case? Also, if you are charging the lower rate of GST, going forward, you have to disclose the percentage of cement you have purchased. You have to disclose what is the percentage from you have taken from registered, unregistered dealers, etc. It is mandatory to take the GST registration. 180 days interest is payable from the date of invoice or date of claim of ITC. It is date of invoice. Okay, this is point is coming because of this 43BH. Well, 43BH of income tax cannot be equated with second proviso to 16.2 of GST. Second proviso to 16.2 of GST Act read with Rule 37 is from date of invoice. Okay, Mr. Prakash is saying any news of judgment of 16.4 in Supreme Court, please? No, as of now, this 16.4 thing is pending. I think the hearing is also not complete. Mr. Patel says location-based ITC credit. ITC of rented sale office can be transferred to the main unit, manufacturing unit through cross charge from sale office to main unit. Mr. Patel, when you're talking of unit, I understand that it is a different state. If it is a different state, then how can you prove that this sale office is for manufacturing for that distinct person? So this needs to be delved into, because a sale unit in a particular state that also sells the goods or assists in selling the good in that particular state. You cannot, generally speaking, until and unless the circumstances are such, it is difficult to argue that if you are manufacturing in one state and you have a sale office in the other state, that sale office is catering to the manufacturing unit. There is a stock transfer between the manufacturing unit to that state in which the sale is happening. So in my view, that sale unit is actually serving that particular state only. And it is difficult to argue that that sale unit in a different state is serving the manufacturing unit. This is because of this distinct person deeming fiction in the GST law. Okay, last question. Any judgments for non-payment of interest where ITC reversed within 180 days? There is no requirement of judgment. It is clear as per the provision section 16(2) and rule 37 itself. Can department issues SCN under 674 or for an SCN issued under section 73? Yes. If you see section 74, it can be issued. Any time limit for TRAN related SCN? As no, there is no time limit, but the time limit under section 73 or 74 would prevail. Registration cancelled retrospectively in one state registration, say West Bengal, but ITC claimed as registration valid on the date of the claim. Now, if registration is active for the same vendor in any other state, say Gujarat, can it be used as an argument to claim eligibility of ITC? Yes, very important. If you see section 79, for the purpose of recovery of ITC, all the distinct person have to be considered as the same person. Therefore, the department is duty bound under section 79 to recover that GST from the other state. Therefore, you can invoke section 79 and claim the ITC because it is the duty of the department to recover the ITC from the other state. You must also take shelter under various other case laws, LGW Industries, Calcutta High Court, DY Bethel, Madras High Court, along with the press note issued in May 2018. So this is a valid case and a good case. So thank you very much to all the participants for joining. Thank you, Team Tax Connect, and thank you, Team VILGST, Samir, for partnering with us for these various indirect tax colloquiums. We have already reached 21. Next month, possibly we'll have another one. Thank you very much. Over to you. I think Samir is there now.
Thank you, Vivek. Uh, I missed the initial few minutes. I'm glad I could join later on. Uh, Thank you to all the participants and joining us on this second Saturday. Some of you might be having a holiday or off. So, thank you for joining us, and thank you, Vivek, for taking us through this some very critical issues or for the upcoming financial year. I'm sure that will help in lot of cases in future litigation and some contentious issue that you have covered and taken all the queries in detail. uh, Thank you. With this, we thank you all the participants and Vivek and team Tax Connect. Over to you, Tetli, if you're there.
I think Pratyay will be there.
Thank you, Vivek sir, for this wonderful deliberation. Thank you, Samir sir from VILGST for coordinating with us. Thanks to all participants for attending the webinar. We conduct such webinars every month and we hope to get you in the upcoming webinars as well. We will shortly share the PPT and video link to all the participants. Thank you.
Thank you. Thank you, Vivek. Thanks.
Thank you. Thank you.